All right, let's get started with Chapter 7. Before we jump into calculating gains and losses, we need to slow down for a minute and make sure we understand some key terms. Everything in this chapter builds on these key terms, so getting comfortable here will make the rest of it a lot easier. The first key concept or key term is basis. Basis is essentially a taxpayer's investment in an asset. For property that is purchased, basis is generally the cost of the asset, and that includes things like the cash that they paid for it, any debt that they took on to acquire that asset, and the value of any other property or services given up to acquire it. So when you think basis, think what did the taxpayer put into the asset? And that's going to be our starting point. Now, sometimes basis is not cost, and this is one of those situations, for example, for inherited property. If property is inherited, the basis is usually the fair market value at the date of death. So instead of using what the original owner paid, we reset the value to what the property is worth when it's inherited. And this is often referred to as a step up in basis, and it can have a big impact on taxes later. Now, there are a couple other situations where basis works differently as well. For example, for property received in a divorce, the basis just carries over from the other spouse. So nothing here really changes. It's the same basis as before the transfer. Gifts, however, are a little bit trickier. The basis of a gift can depend on whether the fair market value is higher or lower than the donor's basis. And we'll dig into that more later, but for now, just recognize that a gift basis isn't always straightforward. Now let's take basis one step further. Adjusted basis is just the original basis adjusted over time. Most commonly, this is for adjustments made for depreciation. So if an asset is being depreciated, its adjusted basis goes down each year. A quick reminder here, land is not depreciated, so its basis is usually going to stay the same. So now that we have adjusted basis, we can figure out whether there's a gain or a loss in a sale transaction. And the formula to figure that out is pretty simple. We take the amount realized from the sale and we subtract the adjusted basis. If what you receive is more than your adjusted basis, then we have a gain. If it's less, then we have a loss. And this is one of those formulas that you'll see over and over, so it is worth getting comfortable with this formula. Now here's a really important idea, and honestly, it's one students tend to miss, and that is the tax treatment. The tax of these sales. The tax treatment depends on how the asset is used, not what the asset actually is. So it's not about whether something is, for example, equipment or land. It's about whether it's used in a business or held as an investment. That use also determines how it gets reported. And that brings us to connecting these terms and the formula to the actual form that these transactions are reported on. There are three key forms that you'll see when reporting gains and losses, and each one depends on how the asset was used. Now, the first form is the form 4797, and that is used when the asset was used in a trade or business. So if we're talking about business property, this is where it gets reported. Next is Schedule D, and this is for investment property, things like stocks or assets held for investment purposes. And this is where your capital gains and losses will show up. And then finally, we have Form 8949. This is more of a detail form. It's where individual transactions are listed, and then those totals flow into Schedule D. So think of it as supporting detail behind the main reporting. So if we take a step back and look at the big picture, we started with the first term, which was basis, which is the taxpayer's investment in the asset. Then we talked about situations where basis can be different, like inheritance or gifts, depending on the donor's basis in the gift versus the fair market value, and also situations like divorce. We also introduced the concept or term of adjusted basis and how depreciation affects it. We walked through how that looks in the total formula. So realized amount less adjusted basis gives you your gain or loss. And then we connected everything together to where it gets reported on the actual tax return or the forms. And that depends on, again, how the asset is used. As we move forward, these are going to be the key concepts that are going to show up again and again. So make sure that this foundation feels solid.